everyone, and thank you for showing up again. I'm glad we have a packed crowd out there. Looks like it's almost over 20 people. So I just want to give you a quick update of the investment challenge. Those who came for the first week, we divided into teams. I recently just sent out a link to each team. There's 3 teams that you can use the free Zoom links that I have sent out if you want to meet with any of the team members to talk about your stock trades or talk about decisions that you want to make as we lead up to the final day. Also, if you can tell me who your 2 team captains are, so that way I know who to expect the reports from. On top of that, I only received one screenshot from team 2 of the stocks that they have picked so far. So I hope everybody is able to meet and get engaged during this week. And with that being said, if you're new to the platform, we try to give you as much financial information as we can during the month of February. It's a weekly event for the month of February, and we'll do it hopefully again next year. So with that being said, we will introduce our guest speaker as she continues to give us the knowledge and the jewels that we need. So Anthea Perkinson, please take it away.
Thank you very much, Anthony. Okay, so today, this is our second session in the Financial Literacy Series for 2022, and we are going to talk about income taxes and tax planning. And while this may seem a little daunting, maybe for some people a little dry, trust me, once you know just a little bit about the tax code and the IRS 1040, you can save yourself so much money. And as we like to say in the world of finance, it's not what you make, it's what you keep after you pay your taxes. So we've got some straightforward objectives for today. Of course, this disclaimer is important. We are not giving specific tax advice. Please consult your investment or tax professional who know your particular situation. Today's learning objectives. I want to introduce you fairly quickly to the current federal tax code. We're going to go through some tax planning basics, what you need to know prior to filing your tax return for 2021. And when is that due? It's due April 15th, 2022. Okay, so we're doing our tax return for last year's earnings. Then lastly, we're going to review some tax management strategies for your high future income. Have some really interesting case studies for you to consider. Understanding the current tax code. Since 2017, with the introduction of the Tax Cut and Jobs Act, we have had a very different tax code from prior years. Made some significant differences. Number one, introduced brand new tax brackets and very different rates, starting much lower, going much higher. We're going to look at those, you know what I'm speaking of. It also introduced new higher standard deduction amounts. Very important. This was a boon for many people, particularly lower income and middle income people. There were also the elimination of a number of other features of prior tax codes. For example, you can't use personal and dependent exemptions to reduce your income taxes as you earn in the way that you could previously. I don't know if you remember filling out a W-9, you could claim that you had 5 exemptions. Presumably dependent children have no taxes taken out of your paycheck, and settle up at the end of the year when you filed your taxes. This system under this code is a much more pay-as-you-go system. You can't claim additional exemptions to have less tax taken out of your regular paycheck. You can ask to have additional taxes taken out, but that ability to kind of manipulate your paycheck is gone. This tax code introduced a SALT cap. SALT stands for state and local taxes. And you may have read about this. This created a great deal of drama and a lot of fighting because this really hit high property tax states like New York, California, Illinois, a lot of metropolitan areas where people have traditionally been able to deduct their local school taxes, which can be fairly high. So property taxes, school taxes, and state income taxes. So it's now capped at $10,000. So even though you may pay $30,000 combined real estate and school taxes, you can only deduct $10,000. So this is a big change for many people. Many other tax deductions and credits were also eliminated. The goal of the Tax Cut and Jobs Act was to simplify the whole tax form and the whole payment process. It made changes. I don't know that it made things necessarily that much simpler, but once you understand how it flows and what is tax advantaged and what isn't, you can navigate this and know what is best for your own situation. Other changes were introduced in 2019. The alternative minimum tax exemption was increased. Now, just a word on this, what it is, when it was introduced. This was introduced many decades ago when it was discovered that people who lived in high tax states that were taking all kinds of deductions for their property taxes, their mortgage interest, the number of children, all these different deductions, were effectively paying much less income tax than many other people by virtue of these deductions. Another group of high earners who were also not paying income tax at the same rate as other taxpayers were people who were invested primarily in municipal bond portfolios, tax-exempt investments, receiving and living on income, interest income, that was not subject to tax. This was deemed kind of unfair and caught a lot of very wealthy people who had great portfolios of municipal bonds. Warren Buffett is somebody who invests this way, for example, in his personal portfolio. And the alternative minimum tax is basically a second way to calculate the tax you owe. And you effectively pay the higher tax amount. Do it the standard way under the current code, Tax Cut and Jobs Act on the 1040, calculated according to the alternative minimum tax method, which eliminates some of your deductions, and see which is bigger. It is a bit more fair, and the reason they came and made changes to it is that this was never indexed for inflation. So more middle income taxpayers were getting caught having to pay the alternative minimum tax, the AMT, as it's often referred to. So what's new for 2021? Well, we still have the legacy of 2020 pandemic-related tax legislation and executive orders. You'll remember the CARES Act, which introduced the stimulus payments. The latest stimulus was called the recovery rebate, and some people were actually paid that final payment in 2021 when they filed their 2020 tax return. That is not taxable income. So there's a lot in the tax code right now just alerting people that you don't have to claim those particular stimulus payments. The other thing that has been made more permanent are the $300 and $600 above the line deduction for cash contributions to charities. Under the current tax code, under the Tax Cut and Jobs Act, you can't make a deduction for charitable contributions unless you are fully itemizing your deductions. I'm going to show you what that is, explain how that works. And this meant that in a period like the pandemic, when you wanted to encourage people to give to charities, give to food banks, help people out, that they needed to create an incentive. So they introduced the ability to make a $300 above the line deduction. So even if you're claiming the standard deduction, you can deduct $300 of your cash contributions. What's new this year is that if you're filing married jointly, you can double that. So you can deduct up to $600 in cash contributions to charities and nonprofits. All right. Also new for this tax year, you may remember the American Rescue Plan that our president signed on March 11, 2021. It was intended to introduce more tax breaks for low and moderate income people, mostly in the form of enhancing various tax credits. Now, just a word to explain the difference between a tax deduction and a tax credit. A tax deduction reduces your income, your taxable income, thereby giving you a lower amount of, a lower tax bill. A tax credit offsets the tax owed. So if you owed $100,000 and you were able to claim a $3,000, if you owed $1,000 and you were able to claim a $3,000 credit, you would now owe only $7,000. So credits can be more powerful and more meaningful to taxpayers than deductions. So this is where a lot of the enhancements to help people were really focused under the American Rescue Plan. You'll recall that the earned income tax credit was enhanced for childless, lower income people. They can now claim up to $1,502. And the tax credit, which got a lot of attention and only recently ended, was increased to as much as $3,000 per child up to the age of 17. This used to go to 16, so they extended it a year. They also made it fully refundable. Now, let me explain what a refundable credit is. I mentioned in my previous example that a tax credit eliminates dollar for dollar the same amount of tax due. If you're somebody who doesn't owe taxes, maybe by the time you finish doing your tax return, your income was not that high, and you get down to what you owe the IRS, and it's nothing, or it's a very modest amount of money, like $100, you're eligible for the $3,000 tax credit. You only owe the government $100. You would get a check for $2,900. So you'd pay off the tax and you would get a refund of the rest of the credit. That's a refundable credit. Some credits are fully refundable. Some are partially refundable, meaning there's a cap to how much you can get back as a refund. And some are not refundable at all. So you either use it to offset tax. If you don't owe tax, that's it. Half of the child tax credit was paid in advance. You remember the $300 a month per child payments that everybody was talking about? These started in July, they went through December, they ended in January. This was a very meaningful way to support families. It had a fantastic impact on the economy and was a great help to all of these families. They got half of what they were eligible for if they met certain income criteria. They will be able to claim the other half when they file their taxes, and they get this fully refundable credit. Now, because this had a means test to it, meaning that if you earn too much money, you wouldn't be eligible for the full credit or any credit. Certain higher income families who receive the tax credit in cash every month are going to have to pay that back and may have a tax bill that's a little higher as a consequence of receiving this. It's the first time the IRS is doing this. It was well-intentioned. We'll see with the current filing on April 15th how this all goes. But I'm hoping that the child tax credit comes back, because I think it did a lot of good. Other credits that were amended, the qualified adoption expense credit was increased. So for families who are looking to adopt or individuals looking to adopt, they can earn up to that amount as a credit on their tax bill. The lifetime learning credit. This is something that all of you who are students should be aware of. And notice that they have a modified adjusted gross income limit. If you're single, 59,000 to 69,000. And if you're married filing jointly, that's what MFJ stands for. This credit is available between 119,000 to 139,000 of modified adjusted gross income. This is a new credit for education. That used to be, under the prior tax code, you could deduct a certain portion for college expenses, specifically tuition. That is no longer available, but this is offered instead, and we'll see if this works out to be more beneficial for more people. To understand how to really do tax planning, it is very important to be familiar with two terms you hear a lot from tax preparers, from CPAs. They're always talking about above the line and below the line, like the rest of the world walks around talking about this. I'm going to explain what it is because it's essentially the two areas on your tax form where you can make changes that will save you taxes. So above the line refers to the fact that as the 1040, as you fill out the 1040, you first come up with your gross income. And I'm going to explain what gross income is and how you add it all up. Then you are going to deduct adjustments to income. And this is a list of very specific things that you can deduct from your gross income. When you've made this subtraction, you get to adjusted gross income, a term you hear all the time. You see AGI referenced in all sorts of articles about personal finance or any kind of stories about means tested benefits. So very important to understand what AGI is. You'll be thinking about it, talking about it for just about your entire life. So many benefits are tied to AGI. Now, when you get to AGI, you're not done. And you haven't even figured out what you owe in taxes. Next, what you have to do is subtract either your standard deduction or your itemized deduction. We're going to go into detail so that you can understand the difference between the two. After you make that subtraction, this below the line adjustment, now you've got your taxable income. So what we see here is that not 100% of your income is taxable. You have two places. You have above the line changes, you have below the line changes that you can make to reduce your taxable income and thereby reduce your tax bill. So I mentioned that you got to get used to that term AGI. Who uses AGI? When is this going to come up? If you want to deduct your traditional IRA contribution, so if you're covered by an employee retirement savings plan at work, either a 403B plan or a 401k plan, you have an income limitation that says whether or not you can make a deductible contribution. If you want to make Roth IRA contributions, same thing applies. They look at your AGI. If you make too much money, you're ineligible to make a Roth IRA contribution. If you'd like to deduct your student loan interest, it depends on your AGI. Want to know if you're eligible for the earned income tax credit? Depends on your AGI. Medicaid, which is for lower income people, health insurance and services, determined by your AGI. If you're on the New York State of Health marketplace in medical insurance programs, your AGI will determine whether you get a premium reduction, currently being called a premium credit. And this is something that people are paying these premiums now. They'll do their taxes, their income will be calculated, first their gross income, then their taxable income. They may get a return in the form of a credit of some of the premiums they've paid for this health insurance. Other income-based benefits, school lunch eligibility, SNAP, housing, FAFSA, meaningful for graduate students. Free application for student aid is looking to find your adjusted gross income. This is why when you fill out that form, you have to retrieve or give them access to your tax return. They're going to check that number and use it for making their eligibility decision. Public Service Loan Forgiveness Program. We're going to talk about this next week when we talk about student loans and income repayment programs. In order to qualify for the Public Service Loan Forgiveness Program, you need to be on an income-based repayment option. Your eligibility for that income-based repayment option is determined by your AGI. If you and your spouse make too much money, you may not qualify. So we'll explain how that works. So much talk about income. What counts as income? Well, obviously your W-2 earnings. If you work for a company and you're having taxes withheld, maybe you're making contributions into your employer savings plan, 401k or 403b, you'll get a W-2 early in the following year that tells you how much taxable income you earned at your job. You might receive a 1099 miscellaneous, MISC, which could be for an independent contract job. You could get a 1099 div for dividends paid on a taxable investment account. 1099 int is for interest paid on a bank savings account or other deposit account. Remember that for 2021, all unemployment insurance payments are fully taxable. In 2020, you got $10,000 free, untaxed, but that no longer applies. All of it has to be claimed on your tax return this year. Any withdrawals from IRAs, 401k plans, 403b or 457b, these monies come out fully taxable. You'll get a 1099-R and have to put that on your return. Distributions from pension plans and annuities, Bitcoin, big deal right now. Your 1040 is going to ask you, do you own any Bitcoin or other virtual currency? The IRS is starting to pay attention to transactions in virtual currency, which are taxable if you have made a profit because the value of your Bitcoin has gone up. Gains from investment account sales. So any of you on Robinhood trading the meme stocks, if you sold and have a nice gain, do remember that the taxman wants his piece. Online gaming winnings in excess of losses are taxable income. Gains from the sale of a home. Forgiven debt in excess of $600 is taxable income. Jury pay is taxable. And interest earned on your federal tax refund. So if you did your tax return, remember last year how crazy it was that the IRS got so far behind that even in January, they were still sending out people's refunds. You get an interest payment with your refund if they are so delayed getting it back to you. Remember that you have to claim that as income when you do your next year's taxes. What is additional income? I mentioned that in the Tax Cut and Job Acts look to simplify the 1040 form, try to make it, initially the goal was make it the size of a postcard. That really didn't happen. It's one long sheet and then two schedules. Schedule 1 is for recording additional income and adjustments to income. So when you look at Schedule 1, which is the second page behind your 1040, you're going to see that that's the line where you put that taxable refund. If you had that interest, for example, from your federal refund, you put it in there as taxable income. If you've received alimony, if you have business income, whether as a sole proprietor, an LLC, you own a corporation, this is all calculated on a Schedule C. So you have the business revenue minus the business expenses, gives you either net income or operating loss. You carry over that number onto Schedule 1 additional income. If you own rental real estate, many people do, this is where you claim that income, net income. And additionally, if you receive royalties, have a partnership, or in a S corporation, etc., this all gets calculated on Schedule E. That net income gets transferred onto Schedule 1. Farm income or loss, here's where you claim your unemployment compensation. Other income. Technically, if you have other income, say, for example, you sell your used car and make a fortune because they're so rare these days, technically that's a taxable event, and this is where you would put that. What are adjustments to income? These are deductions that you can take to simply adjust your reportable income, get to adjusted income. So your IRA contribution, here's where you fill that in. If you are a teacher in a primary school or a high school, you can deduct up to $250 in out-of-pocket expenses, things you need in the classroom. If you have a health savings account and you contribute to that, you would claim that because it is a deduction against your income. You would claim that on this part of the form. Here's where you claim your student loan interest. and so that you're able to deduct it. If you've paid alimony, if you've taken a penalty, paid a penalty on an early withdrawal for savings or a CD, if you've been self-employed and paying for your own health insurance, here's where you claim that expense, etc. So all of these reduce your income, getting us to adjusted gross income. Now, that term above the line opportunities, let's highlight a couple of adjustments to income that could be meaningful to you right now, or when you're out of school and start working. IRA contributions can be a great way to reduce your taxable income. Used to be you could only make these to age 70. Now there's no age limit. All you need is earned income. So you can't take income you've earned from a portfolio or received in royalty payments, but if you have any kind of job or self-employment income, you can use that income to make an IRA contribution. Health savings account. A health savings account, you should think of it like an IRA for your future medical expenses. You get to put the money into the account now, take a tax deduction, it grows tax-free, you use it tax-free for the rest of your life. This can be tremendously valuable, particularly once you retire. As we get older, we tend to spend more on our health and medical expenses. So putting it away, these accounts allow you to invest it and potentially grow it. So this could grow into a pretty sizable account for all those future needs. One of the benefits of these accounts, you don't need earned income. So you don't need to have a job if you're, a rich person living off a portfolio and earning interest and dividends. You could use that money to make a contribution into your health savings account and reduce your taxable earnings. All right, so it does require that you have a high deductible medical insurance plan, meaning that the bronze plan, if you're with the New York marketplace plans. And once you are receiving Medicare Part A, you're no longer eligible to contribute. So, again, it's another way to reduce your current taxable income. Now I have a case study for you. I have Tina, taxpayer. She's 28. She's earned $39,000. She's a Mount Sinai PhD student. So her W-2 says she made $39,345. She also got a 1099 int and a 1099 div reflecting $3,059 in income for sales of Amgen and her brokerage account and some bank interest. Once upon a time, she wrote a successful graphic novel before she went to graduate school. It continues to sell. She gets periodic royalty payments. And this year, great year for that. Everybody's home reading. She got a royalty check worth $1,200 in 2021. So her gross income is $43,604. Now, she is charitably inclined. She made a cash gift to God's Love We Deliver, help get meals to homebound people. She also, on the advice of her mother, made an IRA contribution. This is never too early to start saving for retirement. So after calculating her gross income of $43,000, we make these adjustments to income, and her adjusted gross income down here is $37,304. So we've been able to reduce her income through these adjustments. Those are her above the line adjustments. So next, should she take the standard deduction, or is she eligible to itemize her deductions? And remember, here's the path. We've gone from gross income, less adjustments, to adjusted gross income. Now we're making the decision. Do we take the standard or the itemized deductions? So now we're playing below the line. Just so we know what these values are, for 2021, the standard deduction is $12,550 for people under age 65 who are not disabled. If you're married and file jointly, the combined standard deduction is $25,100. For the itemized deductions, remember all of the new wrinkles under the Tax Cut and Jobs Act. Remember that there is a cap of $10,000 on being able to deduct either your New York State income tax or your local property and school taxes. If you have medical expenses that you'd like to deduct, they have to exceed 7.5% of your adjusted gross income. Mortgage interest, you can deduct up to $750,000, which is colossal. And if you pay private mortgage insurance, which means that you bought a house and you didn't put 20% down, the bank will make you pay for private mortgage insurance. Those additional costs, that expense is now deductible. And of course, charitable contributions. If you're able to itemize, you can make charitable contributions up to 100% of your AGI. So let's talk about her situation. She is again got AGI of $37,304. Is she eligible to itemize? Which would make the most sense for her? Well, she lives in a rental apartment. Okay, so no mortgage interest to deduct. When she looks at her W-2, she sees that she's paid New York State and New York City a total of $2,435. Well, that's not a lot, but we'll make note of it. She did have some out-of-pocket medical expenses. She cracked a molar, ended up having a root canal, and then a crown. It was a disaster, and that added up to about $5,300 by the time she was all done. So can she deduct that? Well, we have to do a calculation. 7.5% of her adjusted gross income, so $37,304, is $2,798. She can deduct the difference. So she spent $5,300. She has to deduct $2,798. So she could potentially claim $2,502 for medical expenses. And when she went through her checkbook and all her receipts, she realized she had given away a total of $800 to various charities and nonprofits. So her eligible itemized deductions, when you add them all up, $5,737. Looking at this, she would obviously take the standard deduction. It's $12,550. So when you subtract that from her adjusted gross income, her taxable income, this is where we're going to calculate her income tax, falls to $24,754. Now, you've probably heard the terms tax brackets, marginal tax rate, and at that point, most people tune out because it sounds very confusing to hear it in words and not see it in pictures. So I want to walk you through the 2021 tax brackets, explain what changed from last year, and how to read these. So we still have the same tax rates. This has not changed, 10, 12, 22, et cetera, et cetera. These numbers have been expanded. They've been adjusted for inflation. So 0 to $9,950 is taxed at 10%. This used to be closer to $9,500 last year. Okay, so that's a benefit. More income is now subject to this lowest tax bracket. You earn more money, this bracket too has been expanded a little, and this one as well. All of them have been expanded to about here, but this, anybody who earns as taxable income more than $523,601 is going to pay 37% on that additional money. Now, the one thing to know that's very important is you not only have income tax brackets and rates, you also have a separate tax schedule for capital gains. Particularly under the Tax Cut and Jobs Act, the capital gains taxes are highly favorable. And most people say this is really just a benefit for very wealthy people, but I'd like to point out that that's not necessarily true, that moderate income people also can benefit from this, and Tina taxpayer can, in fact. We'll show you how. So the way these two tax schedules combine is you figure out taxable income at each of these different rates. Where do we fall out? What's the highest bracket that we're paying? And then you figure out separately the capital gains tax. To the extent that you have taxable income that falls between $0 and $40,400, and that happens for Tina, okay, you take her income, her total taxable income of $24,754. You separate out the income that came from selling her Amgen's shares. That was $3,000. So $21,754 is taxed as regular income, $3,000 because this falls, falls below $40,000. Her sale of Amgen is not taxed at all. It's taxed at 0%. So let's look at what this means in dollars and cents for her. And here are our marginal and effective tax rates. She has income in the lowest tax bracket, 10%. She pays $995. She has income, remember, $21,754 up here, minus $9,951 times 12% is a tax of $1,416. Long-term capital gain of $3,000 taxed at 0. She pays nothing. So her total federal tax bill, this should say for 2021, is $24,111 on taxable income of $24,754 and gross income of $43,000. So you can see that it's a modest tax bite, even for people taking the standard deduction. It's still a good reason if you are moderate income to own investments and to not worry about the capital gains tax, particularly if it's long-term and falls into the long-term tax rate schedule. Now, there is a difference between paying taxes on short-term gains and long-term gains. This is something we talked a little bit about last week. So for example, short-term capital gains are when you own an investment for less than a year and you sell it for a gain. That's a short-term capital gain. That gets taxed like regular income. So that goes into your taxable income tax brackets. If you hold that investment for a year and a day and then sell it, now you get long-term tax, capital gains tax treatment, and you could potentially pay 0 or pay very little for those capital gains. So some future planning for her, if she wanted to sell her remaining Amgen shares at a gain, and she's worried that, oh, you know, if I do this, I have a lot of these shares, I could have well over $40,000 in capital gains, and my income's going to go up next year. What can I do to offset this? She could sell some shares that she owns that are losers, that are underwater, and you dollar for dollar offset those gains to reduce your taxable income. If you have more capital losses than capital gains, you can offset an additional $3,000 of ordinary income, and the rest of that capital loss will simply carry forward to future tax years. So, for example, if she owns, in addition to Amgen, a bunch of airline stocks, these used to be doing very well. And obviously through the pandemic, their fortunes have changed. They've been up and down. Some of them she may now own at a pretty steep discount to what she originally paid. She can sell any or all of them that are below her acquisition price, use that capital loss to offset capital gains up to $3,000 of taxable income too. Mention short-term versus long-term. There is something called a wash sale rule. So for example, what if she really loves American Airlines as a stock? She has an opportunity to sell it while it's under her acquisition price and realize that capital loss. She has to wait 31 days before she rebuys that stock. And that is an SEC rule because they do not look kindly upon people who are selling purely to capture tax losses. So they've put this rule in place. Same thing applies to mutual fund sales. Same thing applies to ETF sales. You have to wait the 31 days. Or they disallow the loss, and that could be a tax problem.
And there, can I jump in here? I'm sorry for cutting you off.
Sure.
Yes, I just wanted to distinguish between long-term capital gains versus short-term. So if I know it starts when, I just wanted to know when, if I guess the long-term capital gains start from the initial investment or the last investment into that stock, because I know some investors go for the dollar cost averaging strategy.
So if that's a great question. And when you are trying to stay on top of whether you have a long-term capital gain or a long-term capital loss, what you can look at online in your account are tax lots. And when you place that sale, you can indicate that you would like to identify the specific block of shares that you want to sell to capture that loss.
Okay, that helps. And also, if let's say the sale that you're trying to trigger is more than the first lot, that will just shift over into the second lot.
Yes, typically, and hopefully that's more than 12 months in a day that you've owned it, so that too will be a long-term capital gain or capital loss. Mm-hmm.
Okay, makes sense. Thank you.
You're welcome. It's a great question. Thank you. So next we have another case study, Tony taxpayer. He's age 45, single. He's a doctor and faculty member, Mount Sinai. And his sources of income, I should say for 2021, hospital W-2 earnings. He earned $279,450 after contributing 3% to his 401k plan. He did some outside consulting. He got a 1099 for this. No taxes withheld, so he's got to claim this extra income and pay taxes on it. He's got an investment portfolio. He earns bond interest from some corporate bonds, dividends from a collection of stocks, and it all added up. Last year was a phenomenal year for the stock market. He's got taxable income of $25,400. So his adjusted gross income, because he makes too much money to make an IRA contribution, he has no other adjustments. So his AGI is $390,450. He takes the standard deduction. He's got taxable income of $377,900. So he's going to have a much, much bigger tax bill than Tina. Remember how the brackets work? He is going to obviously fill the 10%, 12, 22, 24, 32. He's moving into the 35% tax bracket. So he's taking only the standard deduction. He better have some liquidity in his checking account to be able to take care of this bill. What's it going to look like? Well, when you do the calculations and you figure out what the tax is for the income in each of these brackets, these are the amounts, okay? So really the only one that we have to calculate specially is this last one. Taking his taxable income of $377,900, subtract 209, he's paying tax on $168,494. These are the taxes owed. And you can see that last bracket particularly stings. So when you add these all up, his federal tax bill, $106,816 on taxable income of $377,900, oops, and adjusted gross income of $390. That is a pretty substantial tax bill. So let's look a little deeper into his particular situation. First thing we should point out is he's only been contributing 3% to his employer's 401k plan. Well, he could shelter more income if he put more into that tax deferred plan. He never followed up to enroll in his employer's deferred compensation plan. And he's been debating whether to buy an investment property or a home so he can stop paying rent. He gives money to charities and not-for-profit causes, but he's kind of haphazard. He just does it when the mood stirs him, and he doesn't really do it in any consistent fashion or keep good records. Here's his makeover. First, we would recommend that he contribute the max allowable for 2021 and for 2022 into his 401k plan. Put in the full $20,500 a year. At least reduce your taxable income by that much. You'd be paying it otherwise to the IRS. Enroll in the deferred compensation. You don't have to put the full amount in, but you could put some. In our example, we use the whole thing because he's looking to build his assets and his net worth. He's going to put the full amount in both of these tax advantage savings plans. So now when you add these together, it's $41,000. You take his gross or his adjusted gross income minus $41,000. His new adjusted gross income is $349,450. And in the same year, he buys a co-op or condo with a $460,000 mortgage, 30 years at 3%. When he finishes with this transaction, he's got deductible closing costs of $4,000. He's paid some mortgage interest of $11,428. That too is deductible. He's now eligible for that SALT deduction. A combination of what he's been paying in New York State income tax and his new property taxes. Add that together, you can only claim $10,000. And instead of willy-nilly giving money to causes he is passionate about, he's opened up what's called a donor-advised fund or charitable gift fund. He's made one lump sum deposit into that account, and he will write checks out of that account to all of the entities he wants to support. In the year he makes the contribution, he deducts the full $10,000. So now he's got total itemized deductions of $40,428. Big difference from $12,555. So you subtract this from his adjusted gross income, his new taxable income, $309.22. Let's see what his new tax bill looks like. So obviously nothing changes in all of these brackets. Same number, same tax amount. But here, because his adjusted gross income, or his taxable income rather, is so much lower after all of these new deductions, when you subtract 309 or 209 from 309, you're paying tax on 168, or actually on 99,616 at 35%. So rather than pay 58 for this bracket, he's paying only 34. So rather than pay 106,000, he's now paying 82, almost 83,000. We have saved him $26,000 roughly. And he's got money in his 401k plan. He's got money in his deferred compensation plan. And with every mortgage he pays, every mortgage payment he makes, he's growing the equity in his apartment. So he is building his net worth and saving on taxes. So this is just an illustration of the way to wealth by thinking carefully about how to plan around taxes, income taxes.
Yeah, we have a question from Brandon.
Yeah, hey, yeah, sorry. Could you just explain really quickly what a deferred compensation plan is? Because intuitively, it sounds like you're just deferring that income however many years it's still going to happen. So I don't think I understand it completely. Could you just spend a couple minutes?
Sure. I'm happy to explain how this works. This is, they have some other names for it, executive compensation plans. They are restricted to higher earnings in a particular organization. Nonprofits can have these. Corporate entities, public entities can have these. And it is an opportunity to save money on a tax deferred basis, typically also through payroll deduction. What is different about it is your 401k or 403b is ironclad protected by the Department of Labor, by the Department of the IRS. A deferred compensation plan is based on the full faith and credit of your employer. So For example, if you work for a corporate entity and it goes out of business, you're potentially at risk that there's no guarantee on any money you've deferred into this plan. But these plans can be a very effective way for high earners to simply defer recognition of this take-home income. You put it in, you contribute it pre-tax, so it saves on your current tax bill. When you leave employment, whether you retire or you move to another job, when you signed up for this plan, have indicated how would you like to receive that money? Do you want it as annual payments for 5 years, annual payments for 10 years, or one big lump sum? And you can make different decisions based on what you think the future will be on how you take the money out of this account. So it's a helpful way to build wealth and to control your tax profile when you are earning a big paycheck. I hope that's helpful.
Yes, thank you.
Okay, so some tools, tips, and resources. If you earn less than $57,000 in 2021, the volunteer, VITA stands for Volunteer Income Tax Assistance Program. They have trained tax preparers, enrolled agents, people who do taxes for a living, who are located in a lot of public libraries, your public library system. You can call 311 to find a VITA site location near either where you work or where you live. And some of them you can make an appointment and go in. Some of them, you just walk in. The earlier you go, obviously, the less overrun it will be. And particularly if you have a fairly simple return, you've got your W-2, you have a few 1099s, but you don't have some complicated business or partnership, this is a very good source of free help. If you have a very simple W-2 and interest, 1099 interest situation, go ahead and try the IRS free file. This, you can find it at irs.gov, just in their search bar, do free file. They have a number of the tax software providers who offer their software for free. So H&R Block is in there, Intuit, I think, is in there. There are a bunch of them, and they'll tell you, you figure out if you fit their criteria. You earn under a certain amount, or you have a certain type of income, you get to use the software for free and not have to pay a tax preparer. Now, another note, again, looking to help you build wealth, if your taxable income, so your adjusted gross income minus your deductions, whether standard or itemized, comes to less than $40,000, you're going to pay a pretty modest income tax bill to the federal government. And so doing a traditional IRA and reducing this amount of taxable income by another $6,000 if you're under age 50 is probably less meaningful to you than to create a tax-free account for your use in the future. So you could open up a Roth IRA, not take the deduction, and if you wait, and by the time you're 59 and a half, and if this Roth IRA is older than 5 years, this account is older than 5 years, you can take not only your own money out, but all of the earnings on that money, tax-free forever. So that's very powerful. It's a huge incentive to contribute to those accounts early. Obviously, as you start to advance in your career and make more and more money, you're going to want the tax deductions that you can get. And you may not be income eligible for a Roth. So fund one early if you can. Again, just the reminder, federal student loans, the income-based repayment plans that are needed to keep some of these student loans payments affordable and you eligible for public service loan forgiveness is based on AGI. So just be mindful of that. New York Public Library offers free workshops on taxes, tax prep, and they are a great source if you want more information on this particular topic. All right, so that concludes my presentation here. Happy to take any questions, and then we're going to spin and talk about the investing challenge.
There's a question from Chris. Chris, could you come off mute and ask your question?
So my question was like, could you explain it specifically, like what is the 1099 form and like how can it help also to decrease the taxable income?
Okay, I'm happy to explain what a 1099 is. A 1099 is actually an income reporting document, and it is sent to you by your bank, your investment company. Say if you had an account at Fidelity, you had a taxable brokerage account there, they'll send you a 1099 at the end of the year, and it will show all the dividends that you received in your investment account for the year. If you have a taxable account, you have to claim that as income on your income tax return. So same thing if you earn interest on your bank savings, you'll get a 1099 and you have to claim that on your income tax. So it actually, because it's reporting income, will increase your gross income and potentially your taxable income.
Oh, understood. Thank you so much.
You're very welcome. Thanks for the question.
Dr. Augustine.
Hi, I had two quick questions. The first one was about the standard deduction amount. Could you repeat how
Sure.
you qualify for that?
Okay, happy to explain this. I'm glad you asked because it's important to know. Every year, generally by the end of the year, sometimes in January, the IRS comes out with these two numbers, the standard deduction. And it says if you are a single taxpayer, when you do your taxes, after you add up all of your income, you can deduct $12,550 from that income to get to your taxable income. If you are married filing jointly, you get to double that amount. You get to deduct $25,100 from your combined income. So we don't get to pick our standard deduction. It's kind of selected for us by the IRS. And so the choice we can potentially make is whether to use the standard deductions based on our tax filing status, single, married filing jointly, or if we have enough of them, we can elect to do itemized deductions. But you have to have enough of these deductions to be more than these amounts for this to be an option.
Understood. Thank you. Thank you.
You're welcome.
My
Okay.
second question was, could you speak a little bit more about how you mentioned you could carry over a loss to different
Yes.
years?
Okay, so if you, and I see this a lot, people who inherit investment portfolios, or they have an investment portfolio, they're paying attention to it, and then they go to graduate school, they forget all about it, and all those stocks that they were so excited about are not doing so well now. They invested in Zoom, they invested in Peloton. Those were great stocks 2 years ago. They were going to the moon, and now their fortunes have changed. They're underwater for a lot of people, meaning that most people who still own them paid more for them than they're currently worth. If you sell them, you realize a loss. So say you bought it for $100, you sold it for $50, you have a $50,000 loss. You've owned the stock for more than a year, so you have a long-term $50 per share loss. You can use it to offset capital gains that also happened in 2021. Whether you received a capital gain distribution for a mutual fund you own, or you sold a stock or a fund that was a winner and you had a gain in it, they will offset the loss, will offset the gain dollar for dollar. If you have more loss than gain, the next thing that happens is you can deduct you can use $3,000 worth of capital loss to offset $3,000 of straight income. So it's like a deduction, reduces your taxable income. If you have still more loss than that, so say you really went in big on Zoom and Peloton. And you, when you finally sold these things at a great loss, and say it was like $50,000 worth of loss, and you only had $20,000 worth of gain. Well, you have an excess 30,000, so you offset 3,000 of income. So you've got $27,000 of long-term capital loss. It sits out there. It's on your tax return. When you go and do your taxes again next year, whether you do them yourself on TurboTax or you take them to a tax preparer, they're going to see that you have this $27,000 capital loss, and they will use that to offset capital gains that happen next year. So in this current year, 2022, maybe the markets have another great year. We get more capital gain distributions at the end of the year. You'll have a loss to offset them. It carries forward that way. I hope that helps.
Yes, it does help. Thank you.
You're welcome. Okay.
Okay, we have Jacob Maldonado, then Dr. Douglas Mansell.
All right. I wanted to ask because I'm just getting new to this like tax and stuff and like stuff that has to do with like money and economics and things like that. So I'm 17 right now, and for college, I'm gonna major in economics and like business wise and stuff.
Great.
And I'm gonna get into like the money and like stuff like that. What do you think a person of my age should be focusing on right now?
Focusing on right now, do you have a job?
No, I'm planning on getting one in the summer.
Okay, all right. I think the most important thing to understand, once you are working, make sure you focus on saving some money. And also while you're working, get a credit card. We're going to talk about credit cards next week, how to use them effectively to raise your credit score, what to avoid so you don't get into credit card debt and damage your credit report. I think that once you're working and you have one of those, you can do yourself a lot of good by raising your credit score, being responsible with money. And as you're working, and we'll explain how to use the card very effectively, start saving some money. There's a great guy on YouTube, if you like this topic, Tommy Bryson. He's not a financial professional. He's just a huge financial enthusiast, and he puts out so much content. Most of it's pretty good, and a lot of it is very interesting and a good way to think about things. Okay, and just because he is engaging and you'll stick with it, he's a good guy to subscribe to.
How do you spell the last name?
Bryson, Bryson.
Okay, I think I have it in. I'll put it in stuff in the chat. Next, we have Dr. Mansell.
Good evening. I just had a question in terms of itemized deduction limits. So the only time itemized deductions are suitable is if it surpasses the standard deduction,
Yes.
right? So when I do my itemized deduction, the total amount I can use for state and local taxes is $10,000. Can I automatically put $10,000 down, or that depends on the state that I live in and I have to find that myself?
Well, you're going to have to make sure you have that amount, that you've paid that amount in state income tax or in local property taxes if you own your home. You can find it on your W-2. You can deduct up to $10,000. So say you look at your W-2 and you see you paid, $8,000 were withheld. You can claim the $8,000, but you have to make sure that all of your itemized deductions add up to either more than $12,555 if you're single, or more than $25,100 if you're married. But this is the cap, so you can't deduct more than this. You can certainly deduct less if you.
And medical expenses are only able to be used for itemized deductions if it's 7.5%. So if I make $100,000 and I pay $7,600 for a root canal, then I could put it on. But if I put $7,400 for a root canal, it just doesn't count at all.
Well, slightly more complicated than that, because you have to take 7.5% of your adjusted gross income. So you got to figure that out first. So all your sources of income, less any adjustments, like did you make an IRA contribution, gets to your adjusted gross income. Then you calculate what is 7.5% of my adjusted gross income. That is like your bogey. Whatever that number is, your medical expenses that you can deduct are your medical expenses minus 7.5%, whatever that number is, equals your deductible amount. So what happens is, for a lot of people who are young and healthy, they don't add up to enough. You know, it ends up being, by the time you do the calculations, you may have spent $5,000 or $6,000 out of pocket, but because your AGI is X, you only would be eligible to deduct 2,000 of it or 3,000 of it. And when you add up these different categories, you don't exceed one of these two numbers. So you're forced to use the standard deduction. Does that make sense?
And yes, and those bullet points under the itemized deduction, those are the only ones that you can use, or there's more, and I could figure out about that later.
There is more. If you go to the irs.gov website and put in deductions in the search bar, these are the most common. Some of the others have to do with, business owners, farm owners. There are other less standard ones.
Okay, thank you.
You're welcome. It's a great question. Thank you.
We have Keanu, then Madeline.
Okay.
Thank you. I just wanted to ask real quick if there were any tax implications on the IRS side for contractors.
So for independent contractors, you'll get a 1099. When you're an independent contractor, generally, you don't have any income taxes taken out, either for the federal government, federal income tax, or New York State income tax. So when you claim that income in doing your taxes, it's going to be fully taxable.
Okay, I'll look into it. Thank you.
Okay.
Madeline?
Hi, I wanted to ask if childcare, like I know it's 3,000 per child, but does childcare like daycare or nanny or anything like that get deducted? And rent, it said somewhere for housing, but I'm not sure if that benefit for housing is from the state or is it at all deducted?
Well, for not on your income tax. The income tax really has either the earned income tax credit or the child tax credit. It doesn't give you the ability to deduct for childcare. You could, one way that people handle childcare through your job, if you have access to what's called a flexible spending account, you can have money contributed into an account pre-tax that you can spend on childcare. Your savings is based on your tax rate. So if you're taxed, for example, at the 22% tax rate, that's your marginal tax rate. By putting money into this flexible spending account and paying for daycare, for example, you would get a 22% discount. That's how that works, but not on your tax return, unfortunately. Did that help?
Thank you. Yeah, that's very helpful.
Okay.
Thank you.
You're welcome.
And the rent, there's no deduction for the state?
No. Renters, unfortunately, don't get any tax benefit for renting. Great. So now we can talk about our investment challenge or investing contest. And I wanted to commend Team 2 for their picks. I'll describe to the group the portfolio, and then if any of the team members want to chime in, I'm curious to know why you picked these stocks. It's an interesting collection. But on Team 2's portfolio, we have ExxonMobil. It's down a little bit from when you bought it. You bought it at $81.41, closed today at $80.26. You bought NVIDIA, which is a great company. That has been a red hot stock for a number of years. Obviously, they're in the gaming space, and so they had been doing well, and it's up. You bought it at $243.19 a share. Those shares are now each worth $251.08. Your other pick is Hess, another oil company. Bought it for $95.63. It's now worth $93.31, so it's down a little bit. Your next pick is Amazon, which was $3,152.79 a share. It's now $3,228.27 per share. So that's gone up nicely, at least $100. And your last pick is Excelis Technologies, which is in the biotech space. Bought it for $62.89 a share. It's now trading for $67.28 a share. So that is right now looking like your strongest performer. You did well when you bought, comparing to the S&P on the date of your purchase. The S&P closed at 4,553 cents, and that has gone up to $4,521.54. So your portfolio is looking good. You've got some up, more up than down. And I'd love to know a little bit about your decision making, why you pick these, if anyone would care to comment.
So for this, it was me and Andrew working on this together. I think he said he had a meeting, so he wasn't able to stay for the whole meeting today. But yeah, I also wanted to say, I know that I think there's more members in our group, but we didn't realize until after we had met that there was more members in the group. So we have to work with them in the future. But so when we were doing our meeting, basically Andrew was telling me about how in his own investing strategy, what he usually does is look for ETFs that are performing well. So we came up with the idea to look for the best performing ETFs in the past year, and then pick out like the top 1 or 2 stocks from a few of those ETFs.
Okay.
So that's what we did.
I was impressed. You have 2 oil related stocks in here, which there's right now a lot of attention to commodities, oil as a commodity, because of the current inflation environment. People are expecting commodities to do very well. So I think these are only down temporarily. I think long term, you might see these go up a bit. So it's an interesting strategy for hedging inflation. So very good. Next week.
Something I did.
Yes.
Something just a point of discussion is really interesting, especially to me, because there's a lot of talk in the sustainable energy and the electrical vehicle space. So I find it really interesting. I'm really intrigued to see how oil continues to perform.
Well, they talk about long-term and short-term. Short-term because you have not only inflation going up, raising prices, commodities tend to ride that. They have pricing power, they go up in cost. You also have what's happening in Ukraine with the drama with Russia. If there is an armed conflict, if there's actually, even if it's small, you will see oil stocks go up. It will be dramatic and hopefully brief, but once you have open conflict and war, people get very concerned about the accessibility of oil, and it drives up the prices. Long term, I agree with you. A lot of people look at these companies and say, how are they going to evolve into sustainable energy companies? And I know Mobil, for one, is looking to do that. They're investing in solar, but they can't transition fast enough to get out ahead of these alternative sources. So long term, they'll either become entirely different companies or they'll start to fade. And it's possible that they will end up as other companies have. I'm not predicting this, but it's happened to other companies. Their stars fade and they end up getting pushed out of the S&P 500 because they're no longer relevant. And over, if you look at economic history, if you look at the history of the market, there are lots of companies that went through that. You know, there were companies that made, you know, horse-drawn wagons and wagon wheels and things like that. Industries change. So we'll have to see if these companies keep up. But that's great observation. So next week, all of the teams we expect will have submitted their investment picks. And what I'll do is I will have screens showing the investments, the original purchase price, the current values. And so then we'll have a horse race. Then we'll be able to see who's doing well in the markets and who is, you know, maybe looking to rethink some of their picks. So if you have any questions about the investment contest, I'm happy to answer them, or on today's presentation.
There's another question by Dr. Menzel.
Okay.
Yeah, just one question. Since it's a competition, do you succeed by how much money is generated by the 5 stocks that you pick, or the margin of increase, like 20 or 30% of how much from the stocks? How much the stock that you bought increase in percentage value versus actual dollar amount?
We're going to be looking at both the absolute return and the percentage increase. The other weighting is going to be, what was your investment thesis? Just as we talked about this approach to putting this portfolio together, we want to look at and examine why you chose your stocks. What's your investment thesis? Why did you think that these would be winners? Okay.
Got it. Thank you.
You're welcome.
So if we have no more questions, we
Okay.
had a nice lengthy session today, a lot of great questions, and we hope that the teams got the email earlier that I sent out with the members, and also the free Zoom link I gave each team for my account. It'll be usable any day, anytime, as long as the competition is going. So please feel free to do that. And with nothing else being said, hopefully I will finish editing the video soon. I started doing it, and the software that I was using was free software, and it's kind of acting faulty. So it's delaying my process from editing the video to get it up. But I want to try to edit it so there's not that that many breaks, or you know, the opening where we allow people to come in, try to get all that stuff out of it so that you can get the meat and potatoes of the video. So please allow me some time, but it will eventually end up on our website. But hopefully I'll try to get it done by this Friday. So with that being said, thank you all. Please feel free to come next week. Same bat time, same bat channel.
That's right.
Everyone have a wonderful night.
Thank you. You too.
Thank you.